Here to join us to answer that question is Fundstrat Global Advisors Managing Partner and Head of Research, Tom Lee, joins us once again. And Tom, I guess first, just your initial reaction to the headline number, another 1.31 million Americans filing for unemployment. How does that stack up in terms of the trend and the expectation really that we still wouldn't be sitting here this far into the pandemic?
Yeah, I mean, it's still a tragic number because, I mean, 1.6 million people having to file unemployment. I mean, it's a tragedy, but I think from a market's perspective, it's certainly better than what we were seeing 4 weeks ago. And I do think it kind of gives the investors comfort that, 12 months from now, we could see a lot of this repair, because even in the midst of this sort of restricted recovery, and as you said, some relapses, jobless claims are improving.
Yeah, and when we talk about recovery and repair, some of these companies didn't really even need to repair. When we look at the tech stocks, those FANG names, those have been really outperforming the last 2 weeks. Those have been the ones driving the upside moves that we've seen. Today, though, it's a red day, but overall, that's been the strength. What's your take on how the FANG names have right now kind of decoupled from the overall trend that we had been highlighting before when coronavirus cases were headed in the right direction, and how we saw a rebound in airlines, restaurants, and casino stocks, and now not the case?
Yeah, I mean, I think FANG stocks went through a stress test that is greater than anything we'll see in 5 lifetimes. They survived the Great Depression, and they actually grew their business, their revenues. And I think that means investors realize the value of their cash flow is that much more valuable. So I think they're re-rating, and I think it's a permanent re-rate, and that's why they've blown past their prior highs. And that, along with tech and healthcare, is 75% of the market. So I think the market is re-rating because of that. But you're right, there's stuff that's still left behind.
Well, let's focus in on those epicenter stock names, the ones that were hardest hit, because those have been the ones that you've really been pretty bullish on in terms of how far they have to grow here if things do continue to go well. The last few weeks in terms of coronavirus cases have not gone well. So when you think about what should happen with those names, are you still bullish on those and hopeful that we could see kind of a recovery once we get through the peak case count that we're seeing right now in Texas, Florida, California, and Arizona?
Yes, yeah. I would say that the epicenter stocks, which are really the companies hardest hit by this crisis, are no different than what internet looked like post-bubble in 2002. And, people wanted to stay away from internet. But as you know, the best performing stocks after the internet bubble crashed were internet stocks, because you could buy 100 internet stocks. You could get 96% of them go to zero. So if only 4% survived, you still outperform the S&P over the next 10 years. That's what's happening with epicenter, because their credits are holding in. I think that when you think of binary events like vaccine cure, or if Texas, California, Florida, Arizona, FCAT cases peak, investors start to breathe a sigh of relief, and they're going to come into that 25% of the market that's still depressed.
Let me push back on that point a little bit here when we think about comparing back to the tech bubble, because you're talking about valuations there, and then we're talking about an underlying health issue and a pandemic here that's truly impacting a lot of these companies. You think about airlines, you've been highlighting kind of the exponential return that we've seen this year. You had said the model was kind of showing a full return to travel by August, though we're seeing that start to kind of peter out here. So when we think about how this might be different from back then, and how companies here are very clearly tied to the pandemic in a lot of instances, is it dangerous to just connect the dots completely back to the tech bubble? Because obviously there's still a lot of bankruptcy risks if these companies can't get back to full capacity.
Yeah, the future's uncertain. So you're right. I don't have a crystal ball, so I'm not trying to say like I know what the future is. But if we were to freeze all progress here, then epicenter industries are in huge trouble, because no one's going to get on a plane confidently, go to a hotel, casino, theater. But if you think 12 months from now that technology and healthcare and reengineering are going to make things safer, then the stocks that benefit from the most from this really are the epicenter stocks. So I think it's really thinking about looking forward, and the market's having a hard time now. I don't blame them. But if you look forward, epicenter stocks are really where the big opportunities are.
Also on that front, I mean, we saw this kind of the big boost. A lot of the epicenter stocks caught a boost after we got, more in terms of stimulus here on the fiscal and monetary front. Obviously, still debating and waiting for that phase 4 deal, what could come through, but a lot of people expecting another trillion in stimulus. So when you look at that, could that be something here that might actually give epicenter stocks? Is this, in your mind, kind of the last chance to get into a rally there, or is it possibly the case that the market already is pricing in progress on that front?
Yeah, it's a good question. I would say that, to me, the central bank and Fed's accommodation is really what is keeping people in the bond proxy stocks, the tech and the FANG. And stimulus is popular on both sides, and we have a White House that actually sort of fiscally acts very democratic. So I think the odds are high. And absolutely, it's important because there's a lot of misery for people unemployed. So I think the stimulus is important. And yes, that along with a healthcare solution really would help the economy return to normal. And that's why the epicenter stocks would be the big beneficiary of that.
I also like kind of the data approach, right? Because you can have all of these things going on, but your analysis has really focused in on kind of the historical precedent that was kind of when you were safe to give that all clear when we got back on the 50% retracement level here. But the S&P is sitting about 3150 right now. Obviously, things looking shaky recently. So, I mean, historically, is there any kind of threat in your mind that we could move back below that, depending on where case counts go, and how you might weigh risk reward of jumping in here?
Yeah, I mean, it's a good question because we've climbed so much. So sometimes if someone thinks the air is thin, we could fall. But I take a lot of comfort. I think the VIX is really in a downtrend. I don't think it really wants to break back to 60. And oil has made a prodigious and amazing recovery. I mean, if you want to just think about the signal from the commodity and industrial commodities, it's really bullish. And then, if you look at China, China and US are the two most important economies. China's had a V-shaped recovery. US PMIs are turning. So from an economic perspective, as long as we don't see a severe healthcare outcome, it's not the best case scenario we're experiencing, but it's not the worst case either.
Yeah, and we'll dig into more of that data later on. But real quick, before we let you go, I want to ask one more question, as this is an election year. Interesting to see the markets kind of trade around the Supreme Court decisions we got, which we'll also dig into, looking like Trump's tax returns aren't going to need to come out before the election. But what's your take on maybe how those jitters around whether or not it will be Biden or Trump might actually be making this already historically a very tough year to predict, also now even a little bit harder?
Yeah. I mean, I would say markets don't like close elections. I think if it was clearly a White House incumbent or a new entrant winning, I think the market could deal with that. But when you've got something that's so contested like we are now, you could see how people are trying to view that as a binary event and trying to be on the right side of it. So it's tricky. But again, I don't think in the long term it's going to matter. I think the U.S. recovery is still going to be strong either way, even under different tax regimes.
All right. The latest there from Tom Lee, the man who told us when the rally would be coming. He called the bottom. Fundstrat Global Advisors managing partner and head of research. Appreciate you taking the time to chat.
Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.